Hello, everyone. This is James Fields from Klingenstein Fields. Just after 12:30 on Tuesday, I'm going to just pause here a minute, as I know I can see that people are joining. Every few seconds, we're getting a handful more. I'm just going to wait maybe another 30 seconds or so before getting started. Thank you, everyone, for joining us for this call today. I hope everyone is staying safe and healthy during this trying time. We'd considered doing a Zoom call. Zoom calls were all the rage, but wasn't certain that all of my colleagues and I would be appropriately attired and ready for such a thing yet. This is our first foray in doing a client-wide web-based outreach live, and hopefully it'll all work smoothly. We think it will, but certainly bear with us if there's any technical issues. Most of the media coverage and conversations are around health, as is appropriate. We have found in our decades working with clients that wealth and assets are second in mind and at times concerns to health. Today we will talk about the intersection of the two. We have spoken to a number of you recently and encourage you to continue to call with any questions and concerns you may have. We are here for you now and in the future, and truly believe that if we all work together, we will make it through this crisis stronger than ever. I'm James Fields, President of Klingenstein Fields Wealth Advisors. And with me today on the call, I have Ralph Sinsheimer, Senior Managing Director, and Amy Brackett, Director and Senior Advisor. Today, we're going to focus on our evaluation of what we have seen taking place to date, what we think lies ahead, and what this means for investors. During this call, you can submit questions in one of two ways. If you're listening through a computer, there's a widget on the right side where you can submit questions, or you can email questions during this presentation to Susan Curry at Klingenstein. That email address is Susan, S-U-S-A-N, .Curry, C-U-R-R-Y, at Klingenstein, K-L-I-N-G-E-N-S-T-E-I-N.com. Just to recap how we got here. Late in 2019, we began hearing reports of a new respiratory virus that originated in Wuhan, China. The immediate impact seemed to be not only in health and well-being of those in Wuhan, but on global supply chain and production. Since that time, this highly contagious virus has spread rapidly throughout the world, and according to Johns Hopkins, which has been tracking this since the first patient in Wuhan, there are now over 801,000 cases and sadly 38,743 fatalities. In the United States, as of this morning, there were 164,610 cases and over 2,900 deaths. Some perspective on this is important. While these numbers are large in an absolute sense, they are A, likely much lower than the actual number of cases because of limited testing, and B, they compare with a global population of over 7 billion people and a US population of approximately 330 million people. Ultimately, as our national health leader, Dr. Fauci, has noted time and again, the coronavirus will likely be compared to a very bad flu year. And even the latest numbers of potentially 100,000 fatalities in the United States would be a little more than a very bad flu year historically. According to the CDC, since 2010, the flu on an average year has infected between 9 and 45 million Americans, leading to 140,000 to 810,000 hospitalizations per year, and between 12,000 and 61,000 deaths per year. Each loss is tragic, and we should do what we can to help those in need. And the numbers we hear in the media do need this context. We are essentially seeing two efforts in two areas. First and foremost, containing the virus. And secondly, getting the economy and the country through the economic downturn associated with the virus. The watchwords of the day have become flatten the curve, which represents an effort to control the number of cases diagnosed daily and spread them out over a period so that the healthcare system is not overwhelmed, as it has been in Italy, for example. As a result, many countries, such as Italy, France, Spain, England, and the United States, have essentially shut down. Why? Not because this virus won't eventually be ubiquitous, as influenza is, but rather to manage a small percentage of very ill patients against a limited supply of intensive care infrastructure. As economies have ground to a halt, governments and central banks globally, including the United States, have stepped up their efforts to provide assistance to both individuals and businesses to get them through this trying time. The goal is to be certain that part of the treatment, shutting down large portions of the economy, does not ultimately inflict more damage than the disease. At this time, I'm going to turn over the microphone to Amy, who's going to talk us through the actions the Fed and the federal government have taken to date and are expected to take to support the economy through the crisis.
Thanks, James. I echo your hope that everyone stays well during this challenging time. As COVID-19 has spread globally and been officially declared a pandemic, market volatility has become the norm. Over the past month or so, major US equity indices have declined over 30% from their peak in mid-February and have dropped to levels they were last at in early 2017. This has been the fastest bear market in history, taking the S&P 500 only 16 trading days to reach a 20% drop and 22 days to reach a 30% drop. For comparison, during the dot-com bust in 2000 and the 2008 financial crisis, it took almost a full year for stocks to retreat 30% from their highs. While market downturns are a normal part of the cycle, this drop has been particularly severe, as more than anything, the market hates uncertainty. Over the last few weeks, at least 100 US companies pulled their quarterly or full year guidance in light of global supply chain disruptions, which was reminiscent of 2008 when many banks suspended their estimates. Several Wall Street firms recently suspended their year-end targets for the S&P 500, citing unprecedented volatility amid the coronavirus crisis. Looking forward to how the rapid spread of this virus and the virtual shutdown of many countries could impact future market performance, there are some known and quantifiable factors, but there are many unknowns. Let's break it down. In terms of what we know, the Fed and our government have been clear about their effort to support the economy, individuals, and businesses. The Fed has stated and reinforced through its actions its intent to do whatever is necessary to provide liquidity and support the financial markets and the economy. The Fed pledged to buy as much government-backed debt as needed to bolster the markets for housing and treasury bonds. It also announced that it would buy corporate bonds, including the riskiest investment-grade debt, for the first time in its history. The Fed is also encouraging banks through its discount window actions to provide funding to households and businesses. In addition, a relief bill to the tune of $2 trillion, or about 9% of US GDP, passed last week in Washington, which will offer assistance to tens of millions of American households affected by the coronavirus. In addition to funds for industries, cities, and states, it includes stimulus payments directly to individuals and expanded unemployment coverage. Most adults with income under $75,000 a year will get $1,200 each, with an additional payment of $500 for every qualifying child. The payments phase out with income over $75,000 and stop altogether for singles earning $99,000, and checks are expected to be sent out in the next several weeks. In terms of unemployment benefits, the new law wraps in far more workers than are usually eligible for benefits, including self-employed and part-time workers. Eligible workers will receive an extra $600 per week on top of their state benefit through June. The impact of the virus on employment and the need for these expanded benefits is evident, with last week's jobless claims soaring past 3 million to a record high, which was about 12 times the level of the prior week's claims. Lastly, we're also seeing an acceleration and intensification of efforts around healthcare initiatives for both treatment of coronavirus and vaccines on a scale that is unprecedented, giving us confidence that strides will be made. We will need both preventative therapies, such as vaccines, and treatments like antivirals for sick patients. Many companies involved in these efforts are owned across our client portfolios. For example, J&J is testing a vaccine that proved useful against Ebola and just announced a massive collaboration with the US government to build production capacity for 1 billion vaccines. Human testing of its experimental vaccine is expected by September, with an eye on having it ready for emergency use in early 2021, though we know that widespread use will take a bit longer. Medtronic is doubling their manufacturing capacity for respirators and has introduced capabilities in their respiratory monitoring products to better monitor COVID-19 patients in real time in the hospital setting. And lastly, Abbott and Danaher have both introduced diagnostic tools to test patients for the virus very quickly in just a matter of 5 minutes. Turning now to what we do not know. The great unknowns at this point are how long this crisis will last and how much it will cost in the end. China is just starting to return to normal, following over 2 months of extreme measures implemented to contain the virus. The number of new cases in China is down drastically to almost 0, and today's manufacturing report showed a strong rebound from February. This past week, China closed its borders to foreigners in an effort to contain imported cases and prevent a second wave of the virus. The measures taken in the US were initially less stringent and consistent and have been determined primarily at the state and local level rather than at the federal level, which could impact our success in reducing the spread. As of today, the US has now surpassed China and Italy in terms of number of cases, as James mentioned, over 160,000 and rising. As the third most populous nation, there's potential for the virus to continue to spread significantly, though there are some indicators that social distancing is having a positive impact. There are varying opinions on how long the virus and necessary shutdowns will last. While we think that support of the economy, the markets, businesses, and employees will be necessary for at least 3 months, it is quite possible that this period could be even longer. The cost of government support will no doubt be significant, potentially totaling $5 trillion for 2020, which would be the equivalent of about a quarter of our annual GDP. All that monetary and fiscal policy can do during this time is to put a stopgap in place so that once the virus passes, the economy can function again. So that's where we are now, which leads to the question of what does that mean for investors and how are we addressing the current environment for our clients? To speak to that, I'm going to turn it over to Ralph Sinsheimer, who works with clients to develop and implement their investment strategies.
Thanks, Amy. Let me turn to the subject of coping with and ultimately seeing through the current crisis to some kind of normalcy. The market's dislocation has unleashed a torrent of investor fear. Volatility and the velocity of the downturn have been unprecedented. In a period of just 6 weeks, credit spreads have blown wide open, stocks have fallen dramatically, and the VIX, which is also known as the fear index, has shot up to its highest level ever. With its new normal of daily 1,000-point moves up and down, the Dow Jones Industrial Index has become the manic depressive of the economy. By mandating social distancing and in effect shutting down much of our economy, we have knowingly created a sudden stop recession. Fortunately, the financial crisis of 2008 is not too far in our rearview mirror, so we have a playbook to guide us. Trillions of dollars in various programs are ensuring that liquidity won't dry up, vital industries will survive, and many employees will be able to bridge this critical period. And while COVID-19 is a dangerous enemy, there are reasons to be optimistic that it might be fairly well contained by June. As a result, we return to our fundamental belief that a well-constructed, diversified portfolio will best position our clients to attain their goals. There is often an urge to act for the sake of acting, to become a seller even after a sharp market decline. An old aphorism says, don't just do something, sit there. In this case, we don't really mean do nothing. Rather, the watchwords are don't panic, be vigilant, and unless your circumstances have changed meaningfully, adhere to your long-term investment program. Accordingly, For many clients, we have begun to rebalance portfolios towards their pre-established allocation targets. As in any market downturn, the opportunity to acquire undervalued securities at historically low prices will emerge, and in some cases are already here. What distinguished the recent bull market is an almost indiscriminate rising of all boats. Now that the tide has gone out, we should be able to identify differentiated opportunities with unusually attractive risk-reward profiles. Our current base case is that COVID-19 peaks by the summer, and that the recession is likely to be deep, but relatively short-lived. We expect the contraction in GDP to last through at least the third quarter and will be most acute in the second quarter, when GDP will likely fall by over 20%. There is a concern that the virus will rebound in the late fall, which of course would stretch out the recession. But as I said before, our focus will be on strategic rebalancing and strengthening the quality of portfolios during this time, so we will be well positioned to benefit when the market does rebound. Lastly, we are also keeping a close eye and continuously evaluating investments in those sectors, industries, and strategies that are being most affected by COVID-19. In particular, we're analyzing the short-term versus the potential long-term effects of the virus. We believe that some industries, such as cruise ships and other travel and leisure businesses, will experience challenges well beyond the coming months. Likewise, the oil and gas industry is taking the 1-2 punch of a near free fall in the commodity price, plus an extreme drop in demand as people shelter in place. So in the short term, many businesses are experiencing both the pain of lost revenue and the cost of supporting furloughed employees. The relief bill alleviates some of this, but obviously there'll be more human suffering and significantly reduced corporate profits for at least the remainder of this year. All of this and more are areas that we are monitoring daily. James, why don't you take it from here?
Thank you, Ralph, and thank you, Amy. That was very helpful. I wanted to provide some perspective and utter a phrase we are taught in our industry never to say, which is that this time it's different. I do not mean to say that we will not recover from this as we have other crises. However, this pandemic is unprecedented in the speed in which it has infected people globally, even more so in the global response by governments and central banks. Particularly in the United States, this is the case, as recent contagious viruses, SARS, MERS, swine flu, etc., had limited impact to the health of the US population and to the health of our economy, whereas we are now the nation, as Amy noted, with the most cases of coronavirus worldwide. However, leaders around the world are moving from reactive to proactive, and as such, you are seeing increased stability in the markets. What financial markets react to least well, as Amy also noted, is uncertainty. We will get through this. Once more certainty on how bad the virus will be and when it will be at its worst. Regardless of the facts associated with those points in time, the markets should move to steadier improvement. In fact, markets are forward-looking, and as they began to sink before it was clear how badly the spread of the virus would become, they should also begin to move up before the worst of this pandemic is over. Dislocation in the market creates opportunities as well as challenges. At Klingenstein Fields, we are thoughtful, unemotional, long-term investors. This means acting to take advantage of market opportunities, as well as remaining patient when we believe near-term changes may be fleeting or hard to evaluate versus long-term objectives. We remain your investment professionals. Our teams are working nonstop to evaluate, compare, and act on opportunities, as well as remain invested in positions and managers that we believe will regain strength as the economy recovers. We are taking very stringent actions to manage client portfolios in light of the ongoing crisis and market volatility. Each client portfolio is being carefully reviewed by the client relationship team and the investment committee to identify potential areas to address. In addition, all of our professionals and the various committees, our investment committee, investment policy committee, asset allocation committee, and others, are meeting daily, if not more often, during this time to assess the impact of ongoing developments on investment strategy. We are all very fortunate, as this webinar indicates, to live in a time of connectivity. And I can confidently say that our ability to conduct business, while not as usual, has not been diminished by the current environment. At this point, I'm going to open it up to questions. Again, if you're listening on a computer, you can submit questions through the widget on the right side of your screen, or you can email questions to Susan Curry at Susan, S-U-S-A-N, .Curry, C-U-R-R-Y, at Klingenstein, Klingenstein.com. Thank you.
Thank you, James and Amy and Ralph. That was great, very informative. So we do have some questions that have come over. I'm going to jump right into it. James, I think this one or these couple are for you. They're sort of similar versions of the same question in terms of, when do we think the bottom is coming, given the ups and downs in the markets? And sort of in a more detailed fashion, if the changes in the market and with investors are unprecedented, then what research and what instruments are you guys using to make recommendations for the future? And how is 2008 seen as comparable? And then, what is the right time to invest in the market if we don't really know what the bottom is? That was a lot, but I'm going to turn that one over to you, James.
Sure, and I'll take a stab at it, and I'm confident my colleagues will augment what I have to say. There's a lot there, so I appreciate that. I think when we think about where the market may bottom, we think about what data we have in front of us today. And based on the data we have today, and as I mentioned earlier, Dr. Fauci's prediction that maybe it's 100,000 potentially that may pass from this, that is now known by the market. And I think it's not unreasonable to assume that we'll retest the recent lows in the market. And specifically, that would mean testing the low on the Dow of 18,214 and 2192 on the S&P 500 as a low. The reasons we might go through those lows would be if the situation on the ground, so to speak, is much worse than we predict today. And while we don't foresee that, it is certainly possible. To the extent that the worst case scenario is as described, and as Ralph mentioned, this is getting much better by June, then we think that retesting the lows would be the likely worst case from here on. As to the unprecedented nature, before I ask my colleagues to opine, it is true that this disease is unprecedented, as is the response of having a globe shutter in place. At the same time, the response from central banks and governments is equally unprecedented. And I think that owning great companies with strong balance sheets and managements, with total addressable markets that in any reasonable outcome looking forward will be strong, working with outstanding managers in a variety of asset classes, allows us to have confidence that while the virus and its morbidity and mortality may be unprecedented in recent times, as is the response, that ultimately the economies and associated financial markets will recover.
James,
Amy,
I would just add. Are we okay? I would only add to the comments you made about market bottoms that it's really impossible to call with precision a market bottom. So we can't offer a specific date. However, given that the initial driver of this market downturn was event-driven rather than cyclical or structural, it follows that the market will likely turn upward once the war against the virus starts to show signs of being won, which, as you noted again, we expect that to occur by early summer. I would also note that in the financial crisis of 2008-09, the bottom occurred in early March 2009. However, those who invested in November of 08 suffered only a relatively modest decline over that 4 months. it then took to hit the bottom. So being a bit early didn't hurt, at least in that case.
And I would just agree with everything James and Ralph said. And, I think one thing now is analysts are all in the process of updating their 2020 estimates, and there's still a lot in flux. So, earnings estimates for the full year were for EPS for the S&P to fall 2%. The most recent estimates look like they're down closer to 13%, and those might continue to fall. So just to put some numbers around it, if 2020 earnings for the S&P were down 10%, using an average multiple of 17 or 18 times would value the S&P at about 2,500. And if earnings overall were to fall double that, or 20%, that would put the value at about 2,200, and that's right about where it's bottomed out. We do expect a much stronger earnings and a bounce back in 2020, as there'll likely be pent-up demand, and so you should see, once there's more visibility, the markets start to recover.
Great, thank you. Great question too. Another question we've gotten, given that social distancing has been extended for another month and China is, as Amy said, pulling back in terms of open and borders and things like that, how is that affecting the market and personal portfolios, or has that already been incorporated into the market? I'm going to put that over to you, Ralph.
Sure, unless my colleagues want to take it. Say it one more time. I'm sorry, Ellen.
Oh, no problem.
Just the fact that China is closed down?
And the extension of social distancing for at least another month. Is that something that's going to impact the market, or do you think that the market is already?
Well, it certainly has. It's impacted the market. As we know, this will be probably the worst month on record when it closes out this afternoon. And this is all because of the virus and what it does to the economy. So as I mentioned earlier, investors will be wary and have been wary until there is clear signs that this war can be won.
Great, thank you. Another question, or a couple questions somewhat related. You mentioned that certain industries are benefiting, certain industries are being impacted. Which ones do you think in the long term will be the most impacted, either on the plus or the minus side? You mentioned Zoom. Obviously, it sort of is benefiting from this environment, and things like the travel industry perhaps are not. But in the long term, how do you think this is going to play out? James?
Yeah, thank you. Another really good question, and core to what we think about is, when we do get through this, as we will, what will be different? And I think in that sense, maybe the impact of 9/11 is a better example than 2008, in that there were fundamental changes to society and how people went about their business and interacted. That is going to be equally true. I think businesses that allow for ease of telecommuting will benefit. Zoom was one that we mentioned at the top. I think on the other side, businesses that have been clearly disintermediated may not come back so easily. Ralph mentioned cruise liners. I'm thinking also of movie theaters. You have this week, for those of you with children, next week, the next Trolls movie will be out in the theaters and streamed over the top at the same time. So there are going to be some fundamental changes in many aspects of society globally. I think supply chains will change. The countries are not going to want to be as reliant for core inputs from other countries. We specifically at Klingenstein have been reviewing when it comes to managers very carefully, our managers and their portfolios. And then for the portfolios that we manage internally, we've looked at the changes in the markets and tried to answer that very question, which are, what are companies that may be fundamentally changed for the better, and ones maybe that we've owned that may be fundamentally changed for the worse. And we've been taking advantage in the market downturn to add some names to portfolios that we felt were outstanding companies that have excellent long-term prospects, but that had in recent times, through an 11-year bull market, become quite expensive on a multiple basis. And I can think of a few examples. I'll mention a few right now, one being Nike, a fantastic franchise that has been a very expensive stock. And as Ralph mentioned, the markets had taken everything up for a while. They also, at least in recent weeks, took everything down. Another one is Apple, technology related. A couple of others are American Tower, which is the leading tower company for cell towers. You've seen even an article today in the Wall Street Journal mentioning an increased demand for bandwidth. Well, some of that bandwidth will be mobile with 5G, and there are a number of beneficiaries of that we've looked at. And on the other side, and another on the buy side which we just added, is a company called Intuitive Surgical, which makes robots for surgeries. And while elective procedures have been canceled in this country, that's allowed for a unique historical buying opportunity of an outstanding company. We've already seen in China, which, as Amy mentioned, has begun to reopen, that the rest of their healthcare system, not focused on treating those afflicted with COVID-19, has also begun to reopen. On the other side, there are companies that we have liked for a long time, and as we follow all of our companies quite carefully, we lost confidence that maybe the long-term prospects had not fundamentally deteriorated. One that comes to mind is a company called Air Lease, which we had sold. Fantastic company, leader in its space, leading lessor of aircraft, private company lessor of aircraft to large airlines around the world, particularly benefiting in the last 10 years as air travel grew, particularly in the emerging markets. But as we all know what's happened to travel, that is one that we felt that with strong airlines and those supported by government like ours in the United States, they both own and lease aircraft. They will, quote, hunker down to their owned aircraft as much as possible. And the real opportunity for Air Lease, which had been developing in emerging markets, many of those airlines will not survive this downturn. And we felt it was prudent to take some money off the table through a name like that. So I know I answered the question in maybe greater detail than it was asked, but hopefully that's helpful.
Great answer. A little bit related to that, I'm going to put this to you, Amy. In terms of managers that you are using for portfolios, do you see them making changes to their investments or moving things around to impact returns or mitigate volatility?
Yes, so we're in constant communication with our managers, probably now more than ever, speaking to them about their portfolio. And I think, as James mentioned, they're seeing some of the same opportunities where there's companies that they have been following that were too expensive for a while. One of our managers who've been sitting on a lot of cash is deploying a lot of that cash now. So managers are definitely trying to be opportunistic. And then, in terms of areas of the market for clients who have, positions outside of equity across the different classes, we're also looking into opportunities, for example, distressed managers who can benefit from this environment. So we're meeting internally, I would say now more than ever, and really trying to be aware of what those opportunities are, 6 months or a year from now.
Just to clarify, the managers aren't distressed, but their strategy is distressed debt.
Great, thanks, Ralph. That was a good clarification. Great answer. Another great question or set of questions that are related that we've gotten in terms of inflation and what impact the recovery is going to have on things like inflation, on debt, and whether we see any, either both here and globally, any longer term negative consequences of the actions that central banks and governments are taking. James?
Sure, yeah, that's a really good question, and inflation is something we've been talking about so regularly now for so long. I think everyone who studied economics and finance, at least classical finance, has been shocked by the lack of inflation over the last several years, with extraordinary accommodation by all central banks to keep the economies, particularly in Europe and Japan, going. You saw the same happen here in the United States, even before the current crisis, and China as well. what's been really very interesting is that, normally speaking, the extraordinary policies of central banks would have led to inflation. But in fact, there's a number of theories around this, but because of globalization, because of the ability of capital and other resources to move so quickly to their most efficient use, we have not seen inflation. And inflation is the one thing that we've historically always been concerned about, because it is usually the tip of the spear that leads to a market downturn. Inflation leads to tightening monetary policy, which then leads to the impact of that leading to less lending and more expensive capital, and therefore a slowdown in the economy by design, and therefore a slowdown in the financial markets. We have not seen that. And there is, as we've mentioned before, unprecedented fiscal policy, and there is some chance that this could lead to inflation. But as noted by Ralph, this is a self-induced recession, and the accommodation, much of the accommodation we've seen from central banks is really just to keep the individuals and businesses afloat, so that you do not have the deleterious consequences of mass long-term layoffs and disruption to basic parts of the economy that, if we're right, should be back to reopening or starting within 2 months, let's say, if not sooner. And so we don't, sitting here today, believe that that money will flow through and be inflationary. I think you will see increase, as Amy mentioned, in demand in Q3 and Q4 and into 2021, as all the pent-up demand that is shut off now comes back online. You'll also see changes in behavior. People will never appreciate being able to go to the gym or on an airplane or on vacation or even to the office the way that they might have 2 months ago. We don't, though, believe that that will lead to real inflation globally. And we think certainly the Fed will want to have a chance to unwind some of these policies that they're doing now in the rapid expansion of its balance sheet. And through that, they will naturally, as they did carefully after the in the end of the last crisis, carefully unwind their balance sheet. So we think that it'll be manageable, but it's something that we watch very, very carefully, because it is often the beginning of a downturn that we don't want to see.
Great, thank you, James. Amy, a question for you, or a pair of questions related to what one should be doing with cash and with profits. So given current environment and the very low interest rates, should cash and profits from your long duration bond sales being redeployed into equities at this point? Or conversely, should I keep my money in cash until things calm down in the market? Thanks, great questions.
Yeah, so this is a very good question, and a question I think we've all been getting a lot over the last month or so. Whether, to keep money in cash is now a good time. Shouldn't I keep my money in cash until things calm down? There's an old saying that the stock market is the only business where the product goes on sale and all the customers run out of the store. And the problem is that during a market crash, it will always feel like it's too late to sell, but too early to buy. The market is, by its nature, volatile. And so since, over the last 100 years or so, since 1928, the S&P has experienced 12 declines of 30% or more. And these bear markets on average occur every 7 or 8 years and last a little over 1 year before the market recovers. So understandably, the safety of cash sounds pretty desirable right now, with stocks seeing some of their wildest swings ever. But there is a trade-off for the stability of holding cash. Just to put some numbers on it, $100 invested in treasuries since 1928 would be worth about $2,000 end of last year. That same $100 invested in the US stock market or the S&P 500 would be worth $500,000. So there's a certain amount of risk and volatility that has to be embraced in order to earn higher long-term returns. The decision, though, of whether to hold cash and how much is, of course, client specific. as everyone has different circumstances and different appetite for risk. And so generally what we've been doing is for our clients who are relying on cash for short-term liquidity needs, we're not making any changes. We would stay in cash, and that's there really as a reserve fund. But for clients who want to rebalance back to their long-term equity targets as a result of recent market action, where it's brought equity down, in some cases below what would be a longer-term target, what we've been doing is periodically adding to equity positions on weakness as a way to dollar cost average back into the market. And this reduces the risk of trying to call the bottom or time the bottom by diversifying the contributions over a period of time back into the market.
Great, thanks, Amy. Ralph, this is a related question I'm going to put to you. In terms of overall asset allocation and sort of sub-asset classes, are you making any changes there to either benefit from or lighten up particular exposures? And overall, does it make sense now to lighten equity exposure with the intention, conversely, of rebalancing lower? So, Ralph, that's for you.
Got it. Thank you. And this will be a little bit overlapping with Amy's response just a minute ago. But first, I would say that prior to the onset of COVID-19, we had already reduced our forward-looking capital market assumptions. And these are what are used as inputs for our asset allocation modeling. And we did this, of course, because of the length of the bull market and its resulting high valuations. Generally speaking, as Amy mentioned, the allocation shifts we've made is at least towards rebalancing long-term policy targets. But beyond that, we have been guided by client circumstances. So again, a client with significant near to midterm liquidity needs may be de-risked to reflect the outside possibility that markets freeze up even more so than we've seen them. Another client might be looking to add risk and possibly take advantage of the dislocation. And that client might now or shortly have exposure to, as Amy mentioned again, a top tier distressed debt fund. So it really does depend on who we're talking about, what their time frame is, what their liquidity requirements are, and what their risk tolerance is.
Great, thanks. A couple more questions and then we're going to run out of time. But one question, what shape do you think the recovery is likely to take? And I think people are thinking about the previous recession and sort of that turnaround and bounce back and steady upwards. Do we see that again? James?
Yeah, I think that, we hear a lot about is this going to be a V-shaped recovery or a U-shaped recovery? I like those discussions because both of them have the word recovery. It's real likely that this will roll through the country, through the economy, and through the globe. So I think it's probably more realistic to think of a U-shaped recovery. I'd also rather think that and be wrong the other way than expect a V-shaped recovery and have it be a U-shaped recovery. What do I mean? It means bouncing along a lower level before we see the recovery. I think that's probably more likely. If you look at the spread of the virus and the spread of the reaction to the virus globally, we saw it start in China, then it went to the Mediterranean, the Middle East and the Mediterranean, and then now here to the States. But even within the States, New York being where we all are, who are hosting this call today, Greater New York, and then it's gonna roll through. We've seen hotspots in other places now, whether that's New Orleans, what started in Washington State outside of Seattle. We'll see others, and so as it rolls through, as the apex crests probably here first in Greater New York, we're thinking. University of Washington today said that's probably April 10th. The governor here thinks it's probably a week or so after that. But either way, the different parts of the economy will reopen. So I think it's more likely that it will be longer around these lower levels of economic activity and associated market activity before things get better.
Great. I have two questions from a listener. One is, have we ever seen the service sector hit this hard before, i.e. come to a virtual standstill? And then is there anything that we're thinking about that as an unknown that could impact the long-term investment recommendations, long-term situation and recovery?
Oh, I'll take a first stab at that, and my colleagues, please, should feel free to jump in. The first part is, the answer is no. We've never seen a national or global service sector be shut down, and in this case, shut down by intent. So I think this is clearly unprecedented, and of course, an economy like ours, which is consumption and service oriented, feels this particularly hard. Although I will say there's challenges and opportunities. Working in a restaurant has been a challenge, but working at a grocery store or for an online delivery service has been an opportunity. So I think you're going to continue to see that. In terms of things that, it's by definition, things that we can't anticipate, like black swans, we can't say in advance. But those could go either way. I think people think of black swans as being negative, and there's no question this could get worse. The numbers could be worse than we think. The spread could be more virulent than we think. On the other hand, even in the last few days, and Amy touched on this, it's very likely that Abbott's 5-minute test is going to be made in 50,000 units per day soon. We're going to have a finger prick test to see if people have antibodies. There may be ways that we didn't anticipate even a week ago to do greater testing, and from greater testing, we have the ability to begin opening the economy and putting people back to work maybe more quickly than we once had thought. So the short answer is that we've never seen this before, and we don't know. And I think black swans could be on either side of the equation. And I don't know, Ralph or Amy, if you have anything to add.
No, I think you handle it wonderfully. It's a great question. I think the real answer is if you've seen one crisis, you've seen one crisis, and it's very hard to see the next one coming down right at you. But I would say one scenario could be, and I hate to be ghoulish about this, but number one, we don't know the path of the virus, and that can morph and that could become something even more treacherous than it is today. But add on top of that potential terrorist activity while we're on our back here on the homeland, that would give great pause, obviously.
Great. It was a great question, and thanks for the answers. This last question, it seems like a great one to end with. One listener asked, how is everyone, and this is nice to hear, how is everyone at Klingenstein Fields doing? Is everybody healthy? And how is working remotely? Have you encountered any glitches? Is there anything that listeners should know in terms of how things are going? James, I'm going to put that one to you.
Sure. Well, thank you. First of all, thank you for the question. We appreciate it very much. It's very thoughtful, and we're very lucky to say so far that everyone at our firm is healthy. That doesn't mean to say that most, if not all of us, don't know someone who has been personally affected by this, even very close to our firm. And it is a horrible and tragic set of individual stories throughout our country and throughout the world. And our hearts go out to those families and those people who have been impacted by this directly. Fortunately for us, our professional team is all in good health. We are all working remotely. We got ahead of this, the governor's order here in New York, but we've also taken the last year or two to test our systems remotely, had people working various times from home, made sure everyone could operate fully in a remote environment. And so far it's been seamless. It's created some interesting new workflows. It's created some interesting new relationships internally. We'd much prefer to bump into each other in the hall than just be Zoom calling and doing conference calls. But all of our systems work. We're all here if you need us. I hope and believe anyone listening to this call, when they've tried to get a hold of us, they have. We've been very active with our clients, with the portfolios, with our managers. We look at this as a collaborative business with all of you as our clients. We appreciate the question. We hope all of you are well and continue to be. And certainly if you need anything from us, you should not hesitate to email anyone on this call, anyone you normally speak with, call the main number, email us. We are around, and we are, if anything, more available, as we're all expected to be remotely available than we ever were. And we are fully operational and fully here for you, our clients who make all this possible. So thank you so much. Thank you, Ralph. Thank you, Amy. Thank you, Ellen, for emceeing the questions. We really appreciate it. This has been recorded. If it will be sent out to everyone, and will be available, if not just through an email sent, but maybe on our website if we can facilitate that as well. Again, thank you, everyone. Be well, be safe, be in touch.